Hi, Shaun. Thank you so much for joining the conversation today on our Strategic Medical Brokers channel.
Glad to be here, Kathy. What are we going to talk about today?
So, today I really wanted to focus on seller financing and what that means for not only the structure of a medical practice transaction, but also the benefits for both the buyer and the seller.
This is a really important topic, and seller financing is involved in probably 80% of transactions. So it's a really important subject for our viewers to understand. So,
Absolutely.
but your question was really what is it? And seller financing, in very simple terms, is seller acting like a bank for the benefit of the buyer, usually to facilitate getting a transaction closed.
Right. And then, in what scenario does the seller financing make the most sense for both buyer and seller?
Well, when there's a gap, okay, between what's been agreed upon in a letter of intent and what the bank is willing to provide in terms of a loan, and what the cash is that the buyer has available to put in, if there's a difference between those two items and what the purchase price is, in order to solve the gap, seller financing is needed. And so that's by offering that, we're able to have some benefits from a tax standpoint, but we're most importantly able to get the transaction completed.
Absolutely. In terms of structuring, what is I'm sure there are many ways that it is structured within the deal, but what is the most common way that seller financing is structured?
Well, it's important that number one, that you want the seller financing to have the same protections that the bank is getting if there's a primary lender involved. A primary lender is going to require a personal guarantee. So a seller that's providing seller financing should also get the same protections, the same collateral, a lien against the business, a personal guarantee, and certainly a review and approval of credit. So so that is the scenario there that makes the most sense. Um, and and uh, and so think like a bank, even though you don't have experience being a bank, you want to run it the same way as what the primary lender is offering. There's another benefit is that you can kind of feel confident that if a conservative lender is providing the primary financing, they've kind of done the underwriting work for the seller, so the seller can feel more confident about extending credit for the portion of the purchase price that they're providing financing for.
That's such a great point, and I'm sure provides a lot of comfort to sellers that are considering this portion of the transaction. And from your experience, what percentage of the purchase price is typically seller financed?
All over the board, but I would say typically anywhere from 10 to 50% is really common.
Mhm.
In our listings, we typically offer 10% seller financing. But if it's a really inferior practice that is struggling, you'll see the seller will, to motivate buyers to come forward, they're going to make it easier and easier for them to buy the business. So in some cases, I've seen as much as 90% seller financing.
Wow. Wow. And then in terms of how it's structured, repayment terms, interest rates, amortization schedules, who usually determines that? Is it you, the broker? Is it the seller? Is it the buyer? Is it a combination?
Well, I think the buyer is initially, when they make their offer, is going to come with their idea of what that those loan terms are going to look like.
Hmm.
And so it's up to the broker to kind of push back on that and get those terms to be more market based.
Hmm.
Sometimes we see these ridiculously low interest rates and long terms. And so back just this past week, we negotiated one where written into the agreement was that the seller was going to provide seller financing and but wasn't going to be able to earn any interest for the 10-year period of time that the loan was in place. I mean, how ridiculous is that? Um, so anyway, the buyer starts the conversation and starts the offer with the terms they would like, and it's up to the broker to push back and negotiate more market-based terms.
That makes sense. Bring everyone down to earth and do something that's reasonable for both sides.
Exactly.
So talking a little bit about the benefits for both the buyer and seller, first starting with the buyer, why might a buyer prefer seller financing over conventional lending or SBA lending?
A lot of reasons. Usually the common one is it's faster, it's cheaper. You don't have a loan origination fees. You don't have this thorough credit evaluation. You don't have an underwriter that's pushing back and asking for lots and lots of documentation. So kind of the pain of getting the loan is much lower with a seller than it is with a traditional lender. Um, Another reason we see it is that some buyers are really aggressive with acquisitions, and seller financing is not typically um, reported on a credit report. Um, Sellers don't know how to report that loan to a credit bureau. And so when a third party bank is evaluating this buyer who is on this aggressively acquiring practices, they run the credit report. They aren't going to see all this seller debt that the buyer is responsible for on a credit report.
Okay.
Um, so the buyers like seller financing because that financing basically is invisible to most third party lenders.
And how it relates to the lender, does seller financing being incorporated into the deal improve the likelihood that the loan will approve? Or I'm sorry, that the bank will approve the loan?
It will because the it lowers the amount of money that the bank needs to lend on on this acquisition. And so if the loan amount is lower relative to the value of the business, um, they have lower risk, which makes them feel more comfortable. So they banks are they look favorably on seller financing for their own interest, but also for having the seller be vested in the borrower's success after closing.
And any advice that you would give to buyers thinking about acquiring a practice and what they might watch out for before agreeing to seller financing terms?
Yes, certainly they need to have their attorney closely review any loan notes that the buyer's attorney has drafted. Make sure that they understand all the provisions and that those provisions are balanced and protect the seller who's really taking the risk. The buyer's attorney is going to load it so that the liability and risk to the buyer is minimized as much as possible. So that's absolutely the most important thing. Um, Second thing is really the seller needs to really understand the borrower and um, their financial ability. And
Hmm.
so having a personal financial statement, getting a current credit report is certainly something that they should be looking out for as well.
Okay. And shifting gears a little bit and talking now about the benefits to the seller, why would a seller agree to finance part of the purchase price?
There's really four main reasons why we advocate to our sellers that they at least offer seller financing. The first one is practices that are provide a level of seller financing get viewed more than practices without. And this actually goes to all types of businesses. So seller financing is very desirable for buyers, and so they're going to look for practices that or businesses in general that offer some level of seller financing. So more views means potentially a faster sale. The second reason is that um, the seller that offers financing uh, to a buyer signals to a buyer that they have confidence in the business, that the business is going to be sustainable after closing. And the fact that they're willing to take some money in the future is a vote of confidence. The second reason that buyers like it is that if a seller is going to receive money in the future, the seller is more aligned to support the buyer so the buyer is successful post closing. So they feel more comfortable going into the transaction because the seller is going to be aligned with their interest after closing. Third is that lenders like to see the seller have some skin in the game for their borrower, and lowers their risk as to making that loan. The last reason is really more of a tax benefit in that sellers that receive some of their money in a subsequent year or years pushes some of that capital gains burden into the years that they receive the money in the future.
No, that's great to hear. And I'm sure a lot of prospective sellers wouldn't innately think of those benefits. So it's really great that you were able to list those out. And then what protections would you recommend a seller put in place to mitigate risk?
Yeah, I touched on it earlier, but personal financial statement, credit report, attorney prepared documents. One I didn't mention was there is something that buyers try to slip in all the time. And they try to put in this ability for the buyer to subordinate this loan and be able to place senior debt on
Mm-hmm.
top of them, which
Mm-hmm.
pushes them down and actually reduces their, reduces their security. And so it's very important to have a non-subordination clause drafted by your attorney to protect the risk that they're making for the loan against the business.
Does the buyer ever push back on that subordination clause?
Absolutely.
So it's a negotiation, another point to negotiate along the way.
Yeah, we're usually successful with it. And there's certain cases where we can't get that done, but I would say very high percentage of the time we're able to push back and defeat that request from the buyer.
Mhm. Okay. And then talking from the lens of the lender, and you did touch on this a bit before as well, but how do banks typically view seller financing in a medical practice acquisition?
Favorable because it for them. They like to see the seller have some skin in the game. They like to see the seller have money being paid in the future, so they're aligned with their borrower in terms of things that need to happen for a smooth transition post closing. So they view it as favorable.
So it definitely makes them more comfortable as opposed to more cautious when they're going through the approval process and underwriting and so forth. Okay. Talking a little bit about what seller financing means post close in terms of operational considerations between both buyer and seller as the buyer is taking over the practice, and then what that means for the seller and their repayments. But how can seller financing be a component of the deal, help facilitate a smoother transition period?
I think their goals are aligned. They both want the success of the buyer. And so from a seller's selfish standpoint, they want to get repaid on that loan. When the buyer wants to be assured the seller is going to not have a change of heart after closing, is going to do what they agreed to do during negotiations. And so I think it's somewhat of an insurance policy for the benefit of the buyer when there is seller financing involved that they're going to execute on what they've agreed to.
And then do you notice or have you noticed in your experience seller financing correlating to a longer seller involvement post close, or is it kind of negligible and it really matters on the either employment agreement or transition period?
Yeah, so yeah, find that sellers that have it's really important for the buyer that the seller stay on for say a multi-year term. And if there's a seller note involved, I find that the seller is willing to stay on for the transition period that kind of mirrors the duration of that seller note. They
Mhm.
kind of want to be in the business. They feel confident that as long as they remain in the business, even in an employee role, the business is more likely to succeed. Therefore, they're more likely to get repaid.
That makes sense. And then, if you wouldn't mind just pulling from some of your specific client experiences, what are some of the biggest mistakes that both buyers and sellers make when structuring in seller financing?
I think it's that they don't know their lender requirements before they negotiate the terms of the seller financing. For example, let's say the borrower is going to get SBA financing. Certainly, it's important for the buyer and the seller to understand what a standby agreement is and when that is in place, what those look like, why they're there, and what that means to the seller who is may naively think they're going to get their payments day one because the buyer and seller agreed to it in the LOI. Well, the LOI is a guideline, but the SBA lender in this case is going to say, we're only making the loan if the seller note goes on full standby for the entire 10-year term of the loan. Sometimes it's a shorter term. It's certainly up to the bank to determine that. But um, th those conversations, those negotiations need to happen in advance so there's not surprises later that can absolutely derail the deal.
So it's a little bit of a catch-22 because when the buyer is presenting their initial offer and it's going through negotiations and we're kind of working out those terms of the seller financing structure, they'll have not really had those deep conversations with their lender yet and understand what their considerations are. So post letter of intent execution and when we're going through underwriting and so forth, do you ever notice that the original terms of the seller financing are heavily modified based on the lender considerations?
Absolutely. So it's partly it's being an experienced broker, knowing what the requirements are from that particular lender. If it's SBA, SBA is going to have a standby provision. We just don't know the duration of that. And so it's important to have that conversation up front
Mm-hmm.
and set the expectations with the seller who's providing financing to understand you need to think of this more like a CD than like cash flow that's going to occur right after closing. Um, and if you do that, then less chances that there's going to be problems after close when the lender says, no, we need coterminous language, or no, we need a standby that's going to be 5 years. It's not a surprise.
That's such a great way to put it, and I'm sure provides a good correlation for a seller who's perhaps not very familiar with what seller financing is. It's something that they can kind of compare it to. That's helpful. And then throughout your many transactions that you've brokered, have you ever seen seller financing go wrong? And if so, what lessons came from it?
Fortunately, I have not. And again, we are advocating to our clients that we want to get as much cash as possible from the transaction. So minimize the risk to our client. But so we have not seen that personally. But we've seen the opposite where there's been notes and we've had buyers been so successful, they've repaid that loan down faster than what was agreed. So been good for experience from our side. Certainly heard of horror stories out there before, but again, I think the important conversation to have with your client as a seller is ask them, what are you comfortable with? What is the minimum cash amount that you want out of this transaction? And only put at risk the amount you're willing to lose. And so we have that conversation all the time with our clients. And so, you know, it becomes less of um, uh, a financial, um, issue for them if they lost 50,000 on a deal or 100,000 on a deal when the purchase price that they got cash in hand at closing was far above their expectations.
Mm-hmm. Mm-hmm. And then my last question for you, Shaun, is can you share an example of a deal where seller financing either helps save or close a transaction?
Yeah, the financing, seller financing can make deals happen because take the example of a employed physician that finished their training. They are now coming out of their training with a lot of student loan debt. And so their focus in the beginning is to repay that debt, buy a home, they're taking on more debt. And so they may not have a lot of cash resources to put down for a business transaction. And so it could be a great buyer, the perfect buyer, a great fit for the practice. And but they don't have the required cash they need to make the deal um, meet the requirements of the bank. So in these situations, when the seller can step in and basically lend a portion of their equity in the form of a seller loan, it can be the difference between a deal happening or not for a very good buyer.
Hmm. That all makes sense. And this information is incredibly helpful for not only our prospective sellers who are perhaps watching this video and learning more about what they can expect in terms of what will be negotiated and agreed upon, but also buyers and knowing what their options are, because perhaps they might think it's either cash or bank. They don't know that there's somewhere in the middle that could, like you said, really help shape a deal and make it happen. So I really appreciate your time, Shaun. This has been wonderful.
My pleasure, Kathy.